Hello, I'm MaryAnn. The Canadian dollar has dropped nearly 6% since the end of June, and according to my next guest, it's headed farther south, partly to blame by the falling price of oil. Here to discuss how far and how fast it could go, I have Shaun Osborne, Chief FX Strategist at TD Securities. Well, Shaun, we've seen the oil price drop, the Canadian dollar drop. What's going on?
I think a lot of different things are going on to push the Canadian dollar lower. I think we've had certainly some disappointing data in Canada over the last little while. Growth has been not quite as good as we thought it would have been, or was indicating earlier in the year. And I think alongside that, we've had some other disappointing data that really suggests that interest rates are going to stay low for quite a considerable period still in Canada. Commodity prices have declined. We're getting towards the end of the Fed's quantitative easing experiment. We know that's going to wind up at the end of the month, and that's been quite supportive for a range of risk assets around the globe, and I think that's starting to catch up with commodity prices as well. The fall in oil, though, specifically, I think is related to a number of different things. Global growth generally is quite disappointing. The growth data from China recently has been quite soft as well. Producers fighting for market share, and Saudi Arabia recently has made some quite interesting moves on that front by slashing prices to the Far East to try and maintain market share. That's putting a fair bit of pressure on producers in North America, and particularly in the oil patch with oil at $80 a barrel. We're getting very close to that very sensitive sort of break-even point for a number of producers in our oil patch. So all of these things together, weaker commodities generally, that's not good for the Canadian dollar, but very sharp pressure on oil prices specifically, not good for the Canadian dollar. And that's alongside a generally stronger US dollar. That's still the broader trend here, combining to put quite a bit of pressure on our Canadian dollar. So
where do you see the Canadian dollar going?
We've been looking for weakness for quite a period of time here. We think in terms of the dollar-Canada exchange rate, we're going to head up towards or maintain these levels into the end of the year, and heading up towards the 115 area in the early part of 2015. I think given the pressure that we're seeing on commodity prices, given the strength of the US dollar right now that we're seeing, there is a risk that we see something like that a little bit sooner. We may even see an overshoot beyond that point into next year. So I think there's quite a bit of pressure potentially still to come on the Canadian dollar here.
So 115, what does that give us the other way around?
That gets us to about 87 cents.
About 87, okay. All right. And if we look at the Bank of Canada's decision, which they came out with this week, on forward guidance and removing that word neutral, what does that change anything in terms of what you're seeing?
I think under Governor Polos, there's been a tendency to kind of rewrite the statement every time, so we kind of have to go through this thing with a bit of a fine-tooth comb. Under the previous governors, it's been a bit of a boilerplate statement from meeting to meeting, which doesn't really change that much. But this was another change in communication strategy. I think it doesn't mean anything more than that. They've dropped the forward guidance and the terminology that was associated with that. The policy was, or the bank was in a neutral position with regard to the policy outlook. But they've changed that to suggest that monetary policy is appropriate given the balance of risks around the inflation outlook at the moment, which gives us more or less the same idea of policy settings. Yeah, it's the same but different is the way I characterized it. Okay. I certainly don't think it means that rate increases or rate cuts are any closer than they were Tuesday.
So what's different then?
It was just the terminology. I think it's communication strategy. As I said, I think it's aimed at maybe giving the governor a little bit more flexibility to avoid maybe getting asked from meeting to meeting whether rates are going up or going down. He can basically refer to this assessment of risk being balanced around the inflation outlook at the present time.
Okay. So if we look forward then, say the US dollar is going up, how far, for how long? Do you have any idea?
It's a very interesting question. We think, the dollar's in the midst of a secular bull run. I think from a structural position, there's a lot going on in the US economy that, and foreign exchange, you have to remember, is a game of relatives. It's not that the US is in a stellar position, it's just that it looks much, much better from a growth monetary policy position than many other jurisdictions around the world, particularly in Europe and Japan, where growth is very, very sluggish. Particularly in the Eurozone and Japan, growth very sluggish and deflationary risks are rising again. So monetary policy in Japan and the Eurozone look as if they may be going the other way. The Fed is just getting out of the QE game, and we're talking about still potentially rates rising at some point in 2015. Monetary policy in Japan and the Eurozone is moving the other way. The central banks are going to be easing. So growth is slack. Monetary policy will be easier in the Eurozone and Japan, whereas in the US, the economy looks in still pretty good shape. It's probably going to slow down somewhat in the fourth quarter. We think currently we're tracking around about 3% growth, which is pretty good for the US economy. We may slow down just a little bit in the fourth quarter, but generally speaking, we're looking for pretty solid growth in the US economy over the course of the next couple of years. So that's going to be good for the US dollar broadly. For Canada specifically, there's some issues here. We have an economy that's lagging behind this recovery. We're still not picking up in the way that we'd normally expect to see the Canadian economy do, with the US doing as well as it is right now. And that's something that the Bank of Canada is clearly concerned about. There's a lot of excess capacity in Canada. The level of employment is really not where it should be. Some of our export markets are not doing as well as they really should be. And that's suggesting to us that the bank is going to keep rates on hold for quite a significant period, well into 2015 in all likelihood. So I think alongside a stronger dollar, weaker commodities, the Canadian economy lagging a little bit, that's going to contribute to some upward pressure on the dollar-Canada exchange rate, downward pressure generally on the Canadian dollar against the US dollar. The Canadian dollar may outperform against some of those other currencies, the euro and the yen. But in terms of the exchange rate, that's probably most important for most people.
For an investor.
For us here, it's a case of, I think, continued strength in the US dollar and the Canadian dollar lagging.
So what can I do then? Say I'm an investor, I'm looking at the US economy, seeing that it's doing well. I want to buy some sort of stock, ETF, something like that. What can I do to mitigate my exchange risk?
Well, the question there is perhaps, do you want to mitigate your exchange rate risk?
True.
Some investors do. They want to take the currency out of the investment equation. In that case, you'd buy a hedged ETF or take on a currency hedge of your own, assuming you're a Canadian-based investor and buying a US dollar denominated stock. On the other hand, if you want the currency risk to add perhaps a little bit of additional return, if you believe our forecast that the dollar is going to appreciate, buying exposure to the US equity market on an unhedged basis perhaps makes some sense.
Might actually help you in the long run.
Yes, you will get the benefit of the exposure to the stock market. Hopefully the stock investment will appreciate, but we think you'll definitely get an additional return from the appreciation of the US dollar.
All right, so always something to think about. Thank you very much, Shaun. Very interesting. I've been joined by Shaun Osborne, Chief FX Strategist at TD Securities. Thanks for watching.